Welcome back, everybody. Tips for Mortgage video series. My name is Mike Parkinson. As you know, mortgage broker in Vancouver Island. My cousin Jaden Bax, just outside of Calgary, Alberta. How you doing, Jay?
Loving life, buddy. It's one of those, we're in those beautiful Alberta spring where it snowed a little bit today and then the sun came out and now it's windy and cloudy. So you don't know what the heck
Well, it
you're going to
snowed
get.
here yesterday morning, just so you know.
Oh, nice. Well, you guys deserve that a little bit. I know that things are already green out there and we're probably about a month away from that out here. But life is good. Yeah, it's a lot of stuff going on as per usual, right? And I think it all starts with the announcement yesterday of the Canadian CPI inflation index for Canada at 4.3%, down almost a percent from 5.2 in February, right?
That's awesome. Yeah, you know what? It dropped a lot further than they thought, but a lot of people are still predicting that inflation is going to come down more than they think. So there's a couple different camps there. I think it's gonna. I'm kind of in that camp where I think inflation is going to be down a little bit more this year, but we'll have to wait and see. But it looks that way. So it
Yeah.
could be sticky. We've kind of talked about that earlier. But what do you think?
Yeah, well, I don't think anybody would have said that we would have been at 4.2% already, right? There's a lot of a lot of background stuff going on there, and we talk about a lot of this every week. But it's really it's interesting in how like they say all the Bank of Canada CPI for the United States was down to 5%, which was lower than what they were expecting.
Right.
It just seems like all the indicators are that inflation is heading in the direction that the Bank of Canada and the Fed wanted to head in, but they're still speaking very very negatively, right? And as if the things that aren't, and the refrain that I keep hearing now is absolutely by mid-year we'll be down to 3% inflation, but it's the real fight is going to be going from 3 to 2, right? And so really really negative, and they quote a bunch of things, and one of those is these the job numbers continue to surprise us. They continue and they're showing that the economy is more resilient than we thought it would be. But there's something about job numbers that's really interesting that happens in every single recession. It isn't like like sorry, I'm getting on, but isn't there, Mike? There's something about job numbers that every single recession something happens with job numbers prior to it.
Yeah, they say, oh, you can't have a recession when unemployment's so low. Well, you know what? That's whenever unemployment is the lowest it's been, that's a precursor for a recession every time. So, our analysts that we follow talked a lot about that. And quite honestly, Jay, like the BLS that come up with these stats for the job numbers in the US and all that, bunch of bogus, right? Like they're counting a babysitter starting a business, that kind of thing. Like there's a it's so skewed, it's not even funny. So we don't even know what to believe. The numbers are never correct. They're coming up with there's a participation rate that, like, how do they calculate that? The birth death rate, like all that kind of stuff is factors in, and it changes all the time. I just don't believe the numbers, and don't believe really anything that comes out with the government numbers, because they get changed, and I bet you they'll get revised. Um, the big talk about is that the demand for labor is dropping quite a bit, especially in the U.S. So they think that unemployment's going to shoot up. Once it does, it's going to shoot up fairly quickly. So we'll wait and see on that one.
Yeah, and this time around, employment seems to be a little bit sticky in that
Right.
I think everybody, like during COVID, it was a battle for those places that were still open, receiving government support, wanted money to pay their employees, right? They wanted that government money to keep the doors open, but it was tough to get people. People were walking away from jobs, and it was tough to keep people in your company with you, right? And so, really interesting that a lot of those people who are established business owners kind of know when it's time to start layoffs and things like that. They seem to be holding on a little bit longer this time, maybe because of how tough it was this last go around. So I think you're absolutely right about what's going to happen with employment when it happens. That unemployment wave starts happening. I think it's going to happen incredibly fast. And that's all going to lead towards that recession that we keep talking about, which will have just a huge impact on where rates are going. Rates went up in a way. You've been doing this for 20 years. I'm going on 6 this year. Rates went up in a way that certainly I've never seen and never expected to see. But I think in your 20-year career, you've never seen anything like that either.
I don't think anybody's seen anything like that in our lifetime. Like, Like obviously in the 80s it went up quick, right? But they're talking about a debt to GDP ratio of 20%, not 130%.
Yeah.
Let's talk a little bit about the debt. So we're in the most debt-laden society we've ever seen, and back in, I think there's twice as much debt or more
Yeah.
than back in the 2008 financial crisis, and rates have risen as fast as they've risen since 50s or whatever. So what do you expect is going to happen, like,
Yeah.
honestly? And then there's that. Let's talk about corporate debt. There's going to be corporate rollovers. They're going to have to refinance their debt coming up here. Look at all the troubles they're having with the commercial real estate in the
Yeah.
U.S. It's absolutely mind-boggling when you go from, your corporate debt, you used to 4%, and you got to do it at 8.5%. Like, how's that going to work? Like, where's the
Yeah.
math in that, right? So it just doesn't make any sense. So we're just trying to be realistic. There's all kinds of numbers and predictions out there. What's going to happen? The government's telling you they're going to keep rates up as high as they can till at least to the mid of end of next year, maybe start cutting. I'm not buying that. I'm just not buying it because I don't see how it's going to work. A lot of cracks behind the scenes that something's going to give, in my take. The longer they hold rates up, the faster they're going to have to come down at some point, like you said, when
Yeah.
there's a recession, right? So it all comes back to the debt, comes back to lagging indicators like unemployment is what the Fed and the Bank of Canada seem to be hanging on to a lot, and they're all lagging indicators, and obviously the numbers are not 100% accurate or
Yeah.
close to that. So
Yeah.
when that changes, at some point there's going to have to be a change. We just don't know when. But I think in the next 3 to 6 months we're going to see something really drastic happen. Like I said, all this money's rolling over and it's getting really expensive, right? So
Yeah,
so
and what it means for everybody out there practically is something that we're seeing on the back end of the mortgage market right now. And so,
right,
about 2 to 3 months ago, a lot of rate promos on the 5 year fix. The lenders were really pushing the 5 year fixed, right? And those rates looked fantastic, right? You were going from at a high of around 5.34 on a
yeah,
high ratio, which means less than 20% down mortgage, to it was down around 4.99, something like that. Looked like a fantastic thing. The lenders were pushing that as hard as they could. Now what we're seeing is they're really pushing that 3 year fixed as well, right? And so we're seeing kind of around a 4.64, 4.59 on that 5 year. That 3 year, it's around a 4.84, and the lenders are really pushing that from a sales perspective on our end, but also from a rate perspective on the buyer's end. And it's interesting because those kinds of actions, the banks, lenders are always out to make money, right? Just like every other business, they want to maximize their profit. That is everything that they do, all the great customer service and stuff that they do on the back end, things like that. That's all towards maximizing profit. That 3 year, to me, a lot of people that I'm seeing right now on switch transfers and things like that, they're asking for that 3 year because it seems like a reasonable bet, kind of a little balance between the variability of the variable
right.
and the too long of a term of a 5 year, right? And so, but what it says to me is that 3 years is probably too long of a term right now, even though the 1 and 2 year fixed are really significantly higher than the 3 year. It says to me that those banks believe that something's going to happen, and something's going to happen in the relatively near future, where they'd rather be selling 3 year than 1 or 2 year. Isn't that right?
Yeah, I honestly think that the max, again, Jade and I don't have a crystal ball. This is just what we believe and what we've researched, and throwing some reality in there, right? With what's happening in the world and all the debt and stuff, just can't sustain itself at these high levels. So at some
Yeah.
point, and if you look at over the last 100 years, what goes up comes down, vice versa. The government always seems to keep rates too high for too long,
Yeah.
and keep rates too low for too long. And that's why we're in
Yeah.
this situation, is because they could have started raising way longer before, or way earlier than they did, at a slower pace. And we
Yep.
would have been in a way better position than we are now, instead of cranking rates up over the last year. But I've been mostly working with people between the 1 and 3 year fixed. And like you said, Jay, the 1 year's the highest. But that could work out great a year from now if rates are lower. And the 2 years, fairly reasonable, and then the 3-year fixed is a bit lower than that. So it's up to the comfortability of the client,
Yeah.
and they just need to understand the ramifications if they get into a longer fixed rate. What could be the potential penalty to get out of that if rates are down quite a bit in the next year and a half,
Yeah.
like we're predicting. Like Jaden said, that 5-year fixed or 4 or 5-year fixed right now are the lowest rates compared to everything else, biggest discounts. But is that going to make sense over the next 4 or 5 years? Do you think you're going to save the most money or not? We don't think so. But if you're comfortable with that, and you're just stressed about money and you don't care, and you're happy with the in the 4% range that you're getting, then so be it, right? It's your choice. It's just look at all your options, I guess, is what I'm getting at. Variable, hopefully we can start to see better discounts on the variables, as far as conventional mortgages with meaning that you have more than 20% down. That would be great, because that'll be a really good option moving forward, I think, in the next 3 to 6 months. So it's something to, if you're in a variable right now, I think you're going to be fine in the next year or so. It's been painful. It's been painful this last year, but if you average it over 5 years, I think you're going to be doing just fine. So it's just something to consider. But that's my opinion, and that's pretty much what I've been doing with clients.
Yeah, absolutely. I think we're going to continue to do that. I really think that this is going to be a period of, over the next 3 years, it's going to be significant good balance sheets on mortgages for banks as they get those penalty payouts as people pay out of their 5-year fix there. But yeah, we know it's a stressful time, especially if you're renewing right now. We're always happy to chat with you about the renewal offer being made to you. That might be the best option for you. We might be able to find something better for you. But the big thing is to make that decision, make that an informed decision. Don't just sign that 5-year fixed renewal, send it back to your bank and go along with your day, because that could really come back to bite you in the butt a couple of years from now. So if you're in BC, please call Mike anywhere in BC. He's in Campbell River, but he's licensed BC wide. I'm licensed Alberta wide. We both have access through our amazing brokerages to do deals all across Canada, and are more than happy to chat to anybody at any time. So please give us a call. I would love to hear from you guys, and if we don't hear from you over the phone, we'll talk to you next week.
Sounds good. Thanks, Jay. We'll talk to you next week.
Have a good one, buddy.
Take care.
Bye.